Welcome to another episode of CashOps Financial Insights, where we decode the market trends and economic signals to bring you the most comprehensive analyses. Today, we're diving into the latest inflation data that's just been released and its implications on the economic landscape. So, stay tuned and don't forget to hit that subscribe button if you find our content helpful. In March 2024, inflation showed a slight uptick compared to the previous year, marking a subtle yet noticeable increase to 3.5% from 3.2% in February. This rise in the consumer price index might seem modest, but it's a critical signal in the economic ecosystem, particularly to the Federal Reserve. While the numbers might seem small, let's translate them into real-world consequences. Imagine you spend $100 on groceries every month. With a 3.5% inflation rate, that same basket of goods will cost you an additional $3.50 in a year. It might not seem like much, but over time, this adds up, especially for essential items like food and housing. Let's break it down. The Bureau of Labor Statistics recently published data indicating that not only did annual inflation rise, but month-on-month prices saw a 0.4% increase from February to March. This pattern suggests a persistent upward trend in costs, affecting everything from your daily coffee to your monthly rent. So why does this matter? High inflation typically calls for higher interest rates. However, the Federal Reserve seems to be in a tricky position. Despite expectations of rate cuts to ease borrowing costs, the data paints a different picture. The Fed might delay these cuts, especially with economic indicators like these. The consensus among economists, backed by market behavior, is now pointing towards a stalling of rate cuts, possibly not resuming until late 2024. Inflation doesn't just affect price tags. It can significantly impact household budgets and financial security. For individuals living paycheck to paycheck, even a small increase can be devastating. It forces them to cut back on necessities or go into debt, creating a vicious cycle. Remember, behind those economic statistics are real people facing tough choices. As we parse through the details, let's focus on what's driving this inflation. Housing costs. Housing remains a significant factor, with rents rising by 0.4% in March alone. Annually, that's an increase of 5.7%, which is not just a number, but a reality hitting home for millions. Energy prices, energy costs, though slightly better at a 1.1% increase in March, down from February's 2.3%, are still up by 2.1% over the past year. These figures are crucial for understanding broader economic conditions, impacting everything from manufacturing to what you pay at the pump. Interestingly, car insurance and less volatile categories like food and energy, stripped from the core calculations, also rose by 0.4% in March. This consistency reveals the sticky nature of inflation that the Fed battles to control. Despite the Federal Reserve's efforts, pushing interest rates to the highest in over 2 decades, the promise of 3 rate cuts within the year seems increasingly optimistic. Officials are likely to use these figures to reassess their strategy moving forward. If you're finding this analysis helpful, don't forget to subscribe to our channel CashOps for more updates and deep dives into the economy that help you stay informed. So, what can you do as an individual to navigate this inflationary environment? Here are some practical tips. Review your budget. Take a close look at your spending habits and identify areas where you can cut back. Every dollar saved is a dollar you can put towards rising costs. Prioritize essential expenses. Focus on allocating enough for necessities like housing, food, and healthcare. Delay non-essential purchases until your budget allows. Explore income opportunities. Consider ways to increase your income, whether through a side hustle, negotiation for a raise, or investing in yourself through skill development. Invest strategically. While some investments lose value with inflation, others like certain stocks and real estate can offer some hedge against rising prices. Research and consult a financial advisor to build a portfolio. suited to your risk tolerance and goals. As we look ahead, it's crucial to consider the implications of these trends. The Federal Reserve's dilemma. The Fed's decision-making will be crucial, with each meeting from July to November positioned at critical junctures, particularly close to the presidential election. The pressure to navigate economic policy without political influence is monumental. The Federal Reserve's situation is akin to a tightrope walk. Raising interest rates too aggressively could stifle economic growth and lead to a recession. Conversely, keeping rates too low could further fuel inflation, creating a difficult balancing act. While interest rates are a primary tool, the Fed has other options. It can use quantitative easing, QE, to inject money into the economy, or quantitative tightening, QT, to absorb money and cool things down. Additionally, fiscal policy controlled by the government can be used to counter inflation through targeted tax breaks or spending cuts. Market responses. Major stock indexes have reacted negatively to the uncertainty, with notable declines across the Dow Jones, S&P 500, and NASDAQ, each falling by over 1%. This reaction underscores the market's sensitivity to interest rate prospects and inflation expectations. We'd love to hear from you. Let us know in the comments below what specific questions you have about inflation and its impact on your finances. Is there a particular sector you're concerned about? Are you wondering about strategies to protect your savings? Share your thoughts and we'll address them in a future video or live Q&A session. Election year. Complications. The timing of rate cuts around election season could further complicate the economic landscape. Both parties may attempt to leverage economic conditions to appeal to voters, adding another layer of complexity to the Fed's decisions. There are several ways the inflation story could unfold. Scenario 1. Controlled burn. The Fed successfully raises rates to curb inflation without triggering a recession. This is the ideal outcome, but it requires a delicate touch. Scenario 2. Stagflation. Inflation remains high, coupled with sluggish economic growth. This creates a difficult situation with both rising prices and unemployment. Scenario 3. Recessionary pressures. If the Fed raises rates too aggressively, it could push the economy into a recession, marked by declining output and job losses. As we conclude, it's evident that inflation presents a significant challenge for the global economy. The Fed's strategy, alongside government policies and individual actions, will all play a crucial role in determining the path forward. By staying informed, making smart financial decisions, and engaging in constructive dialogue, we can navigate these uncertain times together. Thank you for tuning in to CashOps Financial Insights. If you enjoyed our in-depth analysis and wish to stay updated with the latest economic trends, please like this video, subscribe to our channel, and share this analysis with peers who would benefit from these insights. Stay informed and make savvy decisions with CashOps. See you in the next video.